Hey guys, welcome to my channel Only Finance and Money. Already we have uploaded a video relating to house rent allowance calculation, and this is the second part of a series relating to tax planning of employees. And through this series we will be educating what all investments or expenses or payments can be claimed as deduction under section 80C. Section 80C investments, you should know about section 80C investments because you can claim up to 1,50,000 as a tax deduction for the expenses or investments made under this section. And you have to know about various options so that you can evaluate the best among these options, and so that you can make maximum out of this section. And here you have to note that we will get deduction not only for investments, we will get even deduction for expenses which we have incurred or payments which we have made as part of our normal day-to-day payments. So the investments or expenses can be broadly categorized into four categories. The first one is uh, qualifying expenses of payments. Say if you have two kids and they go to school, and you pay them fee and you obtain a receipt for that can be claimed as part of section 80C. You can claim stamp duty and registration charges paid for buying your own home as deduction under section 80C. In case of housing loan, you will be paying interest which can be claimed as loss while filing your return. And for principal repayment which you have made, it can be claimed as deduction under section 80C. The second category of section 80C investments are fixed return generating investments. Like say if you invest 1 lakh, you will be getting 8% return. These are of 8 types. One is provident fund, voluntary provident fund. In voluntary provident fund, you can make a payment to provident fund voluntarily apart from what your employer is supposed to pay. And public provident fund, Sukanya Samriddhi scheme, national savings certificate, infrastructure bonds, 5 years fixed deposits, 5 years post office time deposit scheme, NABARD rural bonds. I will tell you about this Sukanya Samriddhi scheme. If you have a daughter, you can open an account in her name and you can invest some amount on her name up to 1,50,000 and claim it as deduction under 80C, and it is not withdrawable up to 14 years. Then there is this third category of investments. These investments provide security to dependents on you, say life insurance premium, uh, and unit linked insurance plan. Unit linked insurance plan differs from life insurance premium in the sense these units are linked to market returns. Say you pay 1 lakh, out of that some amount goes to premium towards your life coverage, and some amount will be invested in markets and you will be getting a return, and it is always subject to market risks. And then the fourth category of ATC is investments generating variable returns, equity linked savings scheme or national pension scheme. National pension scheme is a scheme in which you can invest through a fund manager selected from 8 sources. Here they will be offering based on your age how much will go into debt, how much will go into equity. But the issue with this scheme is you can't withdraw amount till you retire from your job. Then the question comes is how much I have to invest. First you have to consider how much PF is deducted by your employer, and then you have to consider if you have kids how much education fees you have paid for them to schools or colleges in which they are studying. And then you have to consider if you have a housing loan how much is the principal repayment, and if you have a life insurance premium how much is paid for that. 1,50,000 minus all these, the net amount you have to invest and make maximum out of this ATC deduction. Then the important question is where to invest. If you look at it depends on the kind of risk and return expectations you have from that investment. If you say you are a person who likes to take more risk and expects more return, then you can go for ELSS or NPS. Again, here you have to see again, if I want to withdraw my money within 3 years or after 3 years, then you can go for ELSS. And you don't want any amount immediately, then you can go for national pension scheme. If your risk profile is low and you want your amount within 5 years, then you can go for FD, National Savings Certificate, infrastructure bonds, NABARD bonds, post office term deposits. And if you want to invest a sum on your daughter, then you can go for Sukanya Samriddhi scheme. If you want to invest the money in investments only to withdraw the money only after your retirement, then the best option will be PF or voluntary provident fund contribution that you can make over and above the provident fund contribution made by your employer, or public provident fund. If you really like the content of this channel, then press subscribe and like